Welcome back to the Ultimate Trading Podcast. I'm Isabel Maria, and today, we're diving deep into one of the most intriguing strategies in trading, arbitrage. It's a concept that can feel abstract at first, yet in practice, it's about spotting inefficiencies in the market and acting decisively before those opportunities vanish. Arbitrage is, in a sense, a test of both your analytical mind and your execution skills. It's also a strategy where technology, psychology, and timing converge, creating a space where disciplined traders can consistently gain an edge. Let's start with the basics. At its core, arbitrage is the act of buying and selling the same asset in different markets at the same time to exploit price differences. Think of it like this: imagine walking into two stores that sell the same smartphone. One store is selling it for $900, while the other sells it for $950. You buy from the cheaper store and immediately sell to the more expensive store. The profit is clear, and the risk seems minimal. Financial markets operate on the same principle, only the scale, speed, and complexity are far greater. The first thing to understand about arbitrage is that these opportunities are fleeting. Financial markets are incredibly efficient, especially today. Prices adjust within milliseconds, often before a human can blink. This is where technology comes into play. High-frequency trading algorithms monitor multiple markets simultaneously, scanning for tiny discrepancies in prices across stocks, currencies, commodities, and even derivatives. The window of opportunity is tiny, sometimes measured in milliseconds or seconds. That means being fast isn't just helpful, it's essential. Now let's explore why these discrepancies exist in the first place. Markets are populated by humans, institutions, and algorithms, all interacting in real time. Prices are influenced by supply and demand, news, rumors, technical signals, and even human emotion. Sometimes, one market reacts faster than another, or liquidity differences create a temporary gap. Arbitrage exists precisely because of these tiny inefficiencies. To illustrate this, let's walk through a story. Imagine a currency trader named David. David specializes in forex markets, where he studies currency pairs across different brokers. One morning, David notices that the US dollar to euro rate on broker A is slightly different from the US dollar to euro rate on broker B. And the euro to pound sterling rate is also out of sync. On paper, he sees an opportunity. He calculates how much he could earn by converting USD to euro, euro to GBP, and finally GBP back to USD. At first glance, it seems straightforward, a guaranteed profit. But as he digs deeper, he realizes that transaction costs, bid-ask spreads, and the speed at which prices adjust reduce the profitability dramatically. By the time he completes the calculations and factors in all fees, the trade is actually unprofitable. This scenario teaches a crucial lesson: arbitrage is not just about spotting differences, it's about understanding the full ecosystem. Every trade carries hidden factors that can turn a theoretical profit into a loss. Transaction costs, market liquidity, latency, and even the reliability of the trading platform all matter. Skilled arbitrageurs don't just react, they anticipate these variables, building systems that account for real-world imperfections. Let's pause for a moment and consider the types of arbitrage. There are several, and each operates slightly differently. Spatial arbitrage occurs when price differences exist across geographical locations. For example, gold might be cheaper in London than in New York. A trader could theoretically buy in London and sell in New York. Temporal arbitrage focuses on time-based discrepancies within the same market, such as buying after hours when prices dip and selling during active trading sessions when prices rise. Triangular arbitrage, which David was attempting, involves three currencies and exploits inconsistencies in their exchange rates. Statistical arbitrage is a more advanced approach, using historical correlations and data-driven models to predict price convergence between related assets. Risk arbitrage, or merger arbitrage, occurs during corporate events, such as acquisitions, where traders position themselves to profit from market mispricing. Lastly, convertible arbitrage focuses on convertible securities, like bonds that can be converted into stock, hedging positions to exploit inefficiencies. Now, let's bring this to life with a hypothetical case study in equities. Imagine two technology stocks, Company A and Company B. Historically, their prices move almost in tandem because they operate in the same sector and have similar fundamentals. One day, Company A stock drops sharply due to a minor earnings miss, while Company B remains steady. For a trained arbitrager, this divergence signals a potential opportunity. The idea would be to buy Company A and short Company B, anticipating that their prices will converge as the market corrects itself. But here's the nuance: execution is everything. Entering too early or exiting too late can erase the entire profit, or even produce a loss. The trader must consider correlation, sector-specific news, and macroeconomic factors that could cause one stock to move independently. This is why arbitrage is often described as low risk, but it is never risk-free. The low risk comes from the hedge, not from ignoring the market's inherent unpredictability. Technology plays a pivotal role in making these trades feasible. Algorithmic trading platforms allow the simultaneous execution of hundreds, even thousands of trades across multiple markets. Direct market access provides traders with the speed needed to act on arbitrage opportunities immediately. Advanced analytics identify even the smallest discrepancies, while automated systems handle execution with precision far beyond human capability. Now let's add another layer: psychology. Even with the best algorithms, traders must exercise discipline. There is a temptation to chase every tiny discrepancy, to react impulsively to sudden news, or to overleverage. Successful arbitrageurs know when to act and when to step back. They balance speed with strategy, allowing both the human mind and the machine to operate in harmony. Consider the broader lesson here. Arbitrage is more than a strategy, it's a mindset. It trains you to observe markets, understand interconnections, and anticipate corrections. It teaches patience, precision, and a deep respect for execution. It reminds us that while markets are efficient, inefficiencies always exist, albeit temporarily, and those who are prepared can capitalize on them. As we conclude today's exploration of arbitrage, I want you to take away a few key ideas. First, speed and accuracy are essential. Second, every trade must account for real-world factors like transaction costs, spreads, and liquidity. Third, technology is your ally, but discipline remains your greatest asset. And finally, arbitrage is as much about mindset as it is about strategy. It's about anticipation, calculation, and execution in perfect harmony. Thank you for joining me for Tip 59, Arbitrage. In our next session, we'll continue to explore strategies that blend systematic thinking, practical application, and advanced insights to help you navigate financial markets with confidence. Remember, in trading, preparation, precision, and patience are rewarded. Until next time, keep learning, stay disciplined, and trust the process.
Thank you for listening to the Ultimate Trading Podcast by Bells Forex AudioWorks. If you love this episode, hit follow, leave a quick rating, and share it with one trader friend. It really helps. Right now, head to bellsforex.com/tools. 6 professional-grade trading tools, 100% free, no sign-up. Use them on every trade. They're that good. Full guide is free at bellsforex.com or grab the Kindle version on Amazon. Until next episode, trade smart, stay disciplined, and keep building your edge. Happy trading!